Hello and welcome to Close of Business. I'm Alicia Barry. US President Donald Trump's stated policy of making America great again came at a big cost this week. Fears of an economic downturn saw spooked investors drive a $4 trillion sell-off on Wall Street as on-again, off-again tariff threats from the White House against allies like Canada and Mexico ramped up uncertainty. The ASX followed, tumbling to a 7-month low as investors here joined the global rout. Rachel Clayton has the story.
Breaking news from Wall Street right now.
Massive sell-off on Wall Street tied to growing fears of a recession.
Shares on Wall Street have slumped today, led by the Nasdaq.
Red screens, falling stocks and rising fears over the R word.
Are you expecting a recession this year?
I hate to predict things like that. There is a period of transition because what we're doing is very big. We're bringing wealth back to America. That's a big thing.
In no time at all, Wall Street was in a tailspin. The Nasdaq plunged 4%, its worst day since September 2022. The S&P 500 closed 2.7% lower, and the Magnificent 7 stocks were all down, with Tesla plunging more than 15%.
Markets continue to sell off in the wake of additional and continued uncertainty around what the Trump tariff situation is going to look like. Market participants hate uncertainty.
The Aussie share market joined the sell-off with stocks losing $50 billion by mid-morning, but the ASX recovered to close almost 1% lower.
As expected, we are down. We are not as violent as what's going on over the US. We have been moving up and down, less volatile as they have, but we have now declined 7.5% since the peak in mid-February.
Falls on the US stock market will also hit the retirement savings of Australians.
Superannuation funds have had 2 very good years in terms of returns, and so it's I guess, par for the course that you do go through bouts of volatility every so often.
You can be alert, but you don't need to be alarmed. It's if you think about the GFC, during COVID, during other times during super, these blips happen. The key question is be able to hold your nerve and remember it's all about the long term.
US recession fears have flowed through to money markets where interest rates have dropped, helping to reduce payments on government debt. President Trump's comments come against the backdrop of a potential government shutdown as Congress struggles to pass a spending bill and Elon Musk's aggressive cost-cutting measures.
I'm just here trying to make government more efficient. The goal here is let's not have America go bankrupt with waste and fraud.
Volatility is quite normal, and trying to time markets is very, very difficult. But I would say, though, the risk is that given the uncertainty around tariffs in the US and the hit of that to the US economy, along with the Musk's Doge, government spending cutbacks and so on, all of that could risk further falls in share markets in the very short term before we finally reach a bottom.
Market stabilisation at the whim of a president.
Just a day later, hopes for an exemption for Australia from Donald Trump's scattergun tariffs were dashed, with steel and aluminium exports slapped with 25% tariffs. The Prime Minister called the move unfriendly and unjustified, and the steel and aluminium industries have expressed their disappointment, as Amelia Turzon reports.
Donald Trump's America First policy is putting Australia back in the pack.
The United States' decision to impose tariffs on Australian steel and aluminium as part of a global decision are concerning. Such a decision by the Trump administration is entirely unjustified. This is against the spirit of our two nations' enduring friendship.
A US ally of 5 armed conflicts, Australia has been lobbying hard for a carve-out from the 25% tariffs, but trade hawk and Trump advisor Peter Navarro says Australia is not a special case.
The policy is no exemptions, no exclusions, and that will change if the president changes his policy.
This is a bad day for Australia, a bad day because of the decision that our ally in America has made.
The country's biggest steelmaker, BlueScope, says it's still hoping the tariffs will be dropped. In a statement to the ABC, BlueScope said a tariff exemption was negotiated during President Trump's first term. We are disappointed not to have received similar exemption status for now. The company is adding that it's working closely with the Australian trade and diplomatic staff to ensure that BlueScope investment proposition is fully understood. But the tariffs may have a silver lining for the company's US operation North Star in Ohio, which delivered more than 40% of BlueScope's profit last year, as the company's boss, Mark Vasella, told the business last month.
So 300,000 tonnes of tariffs on exports that go out of Australia to the US versus 3 million tonnes of benefit that we get from the tariffs driving up prices in the domestic US market.
Overall, economists say the tariffs have more bark than bite.
Steel and aluminium tariffs into the US only account for 0.2% of Australia's goods exports.
Adelaide Timbrell says the real worry for Australia is if these tariffs impact China, our biggest trading partner.
For Australia, the risks around US tariffs are less about what is hitting us directly and more about how tariffs on other countries are affecting global growth. What this means in the interim is that business confidence will be affected.
Another actual impact is the R word. The hint that the US could head into a recession is sending markets into a tailspin this week. But the American president keeps saying his taxes on imports will help the United States.
Do you think there will be a recession? I don't see it at all. I think this country is going to boom. But as I said, I can do it the easy way or the hard way.
Tariffs and escalating trade tensions are a form of economic self-harm and a recipe for slower growth and higher inflation. They are paid by the consumers. This is why Australia will not be imposing reciprocal tariffs on the United States.
Holding off a full-blown trade war for now.
Investors hate uncertainty, but that's exactly what they got this week. And what was worse for markets was Donald Trump's refusal to rule out a recession. I spoke to leading independent economist Saul Eslake about how real the chance of a US recession is. Saul Eslake, welcome to Close of Business.
Thank you for having me on the program.
Investors have been spooked by the risk of recession, and Donald Trump himself has dismissed the prospect. How likely do you think a recession is?
Well, it's clearly not zero. I wouldn't say it's the most likely outcome. I wouldn't put the probability of a recession in the US at over 50%, but it's clearly more than zero, and it's clearly going up, and it's something that investors need to think about. And indeed, as the movement's not just in the stock market, which is in full-fledged correction territory now, but the bond market and the US dollar itself are showing, investors have been thinking quite seriously about that prospect.
And what's the risk that if these tariffs stick, inflation takes hold, particularly in the US, and we see a situation where stagflation occurs in the US economy?
Well, that is a risk as well, and it's not just investors who know it. Consumers know it as well, as shown by the most recent surveys of inflationary expectations, which indicate that households are expecting higher inflation as a direct result of the tariffs that Trump is imposing on them. So they understand that they're going to be worse off. Business understands that the economic climate and government policies are becoming much more uncertain. And that's the most likely cause or source of a recession if the US ends up having one. It's the sheer uncertainty that Donald Trump has been creating, not only as a direct result of the policies he's implementing, but of the extraordinarily haphazard way in which those policies are being implemented. You know, one day 25% tariffs are on, and they're on everything. The next day some goods are being exempted. The next day some countries' tariffs are being postponed for a month. And then the range of countries that are being subject to tariffs are being increased. And when businesses are uncertain, they pull up the shutters and stop making decisions about investment or creating jobs. When households or consumers are uncertain, they put off buying particularly big ticket items like motor vehicles or houses or going on overseas holidays, and that's the most likely source of a downturn in the US economy. Now, if that's combined with higher inflation as a result of tariffs, as it could be, then it puts the central bank, the Federal Reserve, in a dilemma as to whether to cut rates in order to ward off recession or to raise rates in order to hose down inflation.
And the Fed, of course, meets next week. What do you think it's going to do?
I think it's going to stand pat. The most recent inflation data we've had this week for both consumer and producer prices for February was a little bit better than expected. It doesn't provide a justification for the Fed to cut rates again, but it certainly doesn't warrant them talking about the prospect of any increase in interest rates in near term. Jay Powell, as Fed chair, has said that there simply isn't enough data for the Fed to begin to assess the likely consequences of the things that the Trump regime is now doing. They have to sit and wait and see what the data tells them about not only how the US economy is tracking, but also about the evolving risks facing the US economic outlook before they can decide whether they need to cut interest rates again or whether they need to signal to markets that interest rates could be on hold for a long time.
It seems the people who voted for Trump appear to be the ones who are paying the biggest price.
That's right, and indeed many economists made that point before Trump's inauguration. They made the point that the increases in tariffs, which, to reiterate, are going to be borne by American consumers, not by Chinese, Canadian, Mexican or European exporters, will fall disproportionately on consumers in the bottom half of the income distribution. They're not going to adversely affect the incomes or lifestyles of the tech bros that bankrolled Donald Trump's campaign. Donald Trump isn't going to lose his job as a result of the recession that he says the US might have to have. It's going to be people in lower income communities who lose their jobs, and some of them might start to wonder why they voted for him. But of course, that's too late to have those doubts. Part of the reason why Mr. Trump is able to get away with the things that he's doing is that he is subject to no restraints. He himself, unless he manages to suborn the 22nd Amendment to the US Constitution, isn't allowed to run again.
Briefly, Saul, do you think there's a master plan here, a real end game, or is it just noise and chaos coming out of the White House?
Well, some people suggest that there is a master plan, that Donald Trump and the people around him genuinely believe that it's possible to restore US primacy amongst the community of nations by reinstituting the sort of policy regime that the United States had in the latter part of the 19th century and the early part of the 20th century, when government was a lot smaller than it is today, and it was possible to fund the operations of government through taxes on imports, otherwise known as tariffs. This was before the federal income tax was invented in 1913 and before the US had to develop the range of sales taxes that its states now evolve. Donald Trump thinks that that kind of combination of policies is the way to make America great again. There aren't many economists who believe that. Maybe the handful who do are actually working for the Trump regime, people like Peter Navarro, for example, or the current secretaries of the Treasury and Commerce departments. But really the overwhelming impression that markets are starting to have is that the lunatics are taking over the asylum and that the consequences that flow from it will be pretty catastrophic.
Saul Eslake, thank you so much for your time.
That's been a pleasure. Thank you for having me.
Ex-tropical cyclone Alfred has wreaked havoc, leaving a huge personal toll and economic cost in its wake. Businesses are assessing the damage, and insurers will face close scrutiny for how they handle the thousands of expected claims. Daniel Ziffer has the story.
The damage from ex-tropical cyclone Alfred is still unfolding. In Brisbane, a tree crashed in front of a shop, but that didn't stop the business from reopening.
You've been closed 3 days, we just reopening today. We have to because bills is coming, and we have to survive.
The bills are piling up, as is the pressure on the insurance industry to deal with an expected surge of claims.
The insurance companies need to do the right thing. They have a social licence, and people expect them to make payments in a speedy and effective way when they are due.
Building inflation has gone up 40% in the last 3 years, and when we think about the challenge that insurers have, they're trying to anticipate what the cost would be to rebuild properties in 12 months' time or 18 months' time if the worst happens.
So far, there have been more than 9,000 claims, but that's expected to rise. Some analysts expect the insurance bill to exceed $2 billion. The 2022 floods cost $6.4 billion.
We expect a raft of claims that won't just be property damage, it will also be car damage, and we will see a lot of commercial claims around both business interruption and potentially primary producers impacted in the Brisbane and Lockyer valleys.
More government support is expected to be announced. Already there's help for people in 31 local government areas.
Eligible workers and sole traders in South East Queensland and New South Wales who've lost income as a direct result of ex-tropical cyclone Alfred will be able to access up to 13 weeks of income support.
In Lismore, waters are receding. Businesses here are used to putting things back together.
We've got the helpers here, unloaded everything, brought it back to the office, and now they're going to build the cabinets again.
After the floods of 2022, the owner of this accountancy firm wasn't taking any chances.
We just weren't prepared for the amount of water. So we did pack up, but we just didn't have it high enough.
The impact of climate change-induced extreme weather is becoming more common, with a massive annual study revealing more people are being affected.
In 2022, we found that 4.5% of the population reported their home was severely damaged or destroyed by a weather-related event. That's like 1 in 22 people.
Prompting bigger questions about how prepared we are.
Are we taking enough steps to prevent the adverse consequences of these weather events? If they're going to become more prevalent, do we need to be doing more to weatherproof our homes and our society more broadly?
As two of Australia's most populous states continue to bear the brunt.
The Australian share market booked its fourth straight week of losses, ending just shy of recording a technical correction. The ASX 200 and the All Ords both falling 2% by Friday's close. Gemma Dale from NAB Trade joined me to run through the drama on the markets this week. Gemma, is this a week that investors would rather forget?
Well, look, we have global headlines and tariff news coming daily. Trump has been changing his policies quite dramatically on a daily basis, and that is absolutely rattling markets. But when you look at the actual numbers, particularly on the ASX, they're not dreadful, right? We've seen a 5% pullback over the week in the tech sector. We've seen about a 3% pullback across the other major sectors, particularly financials. If you look at healthcare and so on, they're all back about 3%. Materials stronger, so it wasn't red across the screen. There were some sectors doing okay. Utilities a bit stronger also. So a bit of weakness, but we're post-reporting season. You're starting to see things settle down. And because there's so much geopolitical uncertainty and weakness, particularly in the US, I don't think it's very surprising to see a little pullback this week.
I mean, we have been reporting quite a bit about nearing a technical correction. What's the significance of a correction? Should investors be worried by that?
Yeah, so the definition is the market falls by 10%. It's worth noting we were at all-time highs. So when you're at all-time highs, there is always the potential for you not to make a new high, to come back a little bit. 10%, it's not enormous, right? We see them all the time. It is very common to see pullbacks of 10% or more in a calendar year or a financial year, and then the market just picks itself up and just keeps moving forward, right? So when we look at the US data, a technical correction results in a bear market about 1 in 4 times. most of the time just sort of picks itself up and then makes new highs again subsequently. So it may get worse, it may get better. Most of the data suggests it'll probably get better from here.
So do you think the sentiment that you're saying is going to have investors buying this dip?
So the buy the dip mentality has been so strong for so long, and it's been such a successful strategy. When you look at the market over the last 5 years, worth noting 5 years ago was the COVID low, so very specific data set. Starting at an absolute low, the S&P 500 is up exactly 100%. Which is extraordinary. So buying the dip all the way through that period, you've done extremely well. And the ASX is up 40%, which is not as strong, but still buying that particular dip has played out really nicely for you, particularly if you bought financials. A lot of people did. I think at this point in time, there is a lot of uncertainty, and it's also worth noting, particularly in the US, share prices are still not cheap. Tesla, which has fallen 50% from its high, is still on a PE of 117 times. So we're not talking a cheap market necessarily. You may want to buy the dip, but there may be more dips to come. It's hard to say.
And you mentioned Tesla there. When we look at the Magnificent Seven tech stocks, they have been the outperformers, and Australia's big superannuation funds have quite a large holding, many in that Mag 7 contingent. What's the risk here, given that they've seen the brunt of the selling?
So this is really difficult for super funds and any large asset manager. You're generally benchmarked to these global benchmarks, and the All Country World Index, which is developed markets and emerging, so it's not just exclusively developed markets, is 74% US, or it was at the end of December. It's astonishing. 26% the rest of the world, 74% US.
So you have to be in it, right?
You got to be in it. And of that, nearly 40% was the Mag 7. So it's quite extraordinary how concentrated global markets as a benchmark have been. And as an asset manager, you kind of have to be there. So yes, you're going to wear some pain, but you also had all the run up. So that's all right.
So just ride it out.
It's a challenge. Asset managers should be making active decisions and may have taken some risk off the table prior to this pullback, but you've got to be watching really what your investment manager is doing to have a feel for what the impact's going to be on your portfolio.
Gemma Dale, thanks so much.
Thank you for having me.
Prefabricated housing is cheap, fast and effective, but it makes up just a fraction of total dwelling stock. Experts have increasingly pointed to it as a possible solution to help ease Australia's housing crisis. But despite proving successful overseas, finance for modular homes is still a problem. Here's Rachel Clayton again.
In a high-tech factory, a robotic arm swings into action to cut, nail and shape the wall of a house.
Most of our manufacturing members are producing homes in 12 weeks, compared to traditional constructions taking around 18 months.
Prefabricated homes built on a production line have been lauded as a cheap and fast solution to Australia's need for housing for decades.
The new modular home is built totally in a factory and then transported to the site.
Yet the industry makes up just 8% of all construction.
Our industry is at capacity currently building conventionally. So the prefab industry is an enabler for the construction sector to help to get back to productivity and profitability.
Across the country, states and territories have poured money into prefab to quickly boost supply of social housing, with projects ranging from a few dozen homes to a few hundred. This row of modules is a deconstructed apartment building being made in Melbourne and bound for Queensland.
So this is the kitchen living module, and this will go to site, fully finished, all the appliances installed, and then when it goes to site, the next module that gets installed next to it will have the bathroom and the bedrooms.
In 2024, the federal government announced a $900 million productivity fund for states and territories to reduce red tape, and launched a voluntary certification scheme to simplify prefab home approvals.
If you had a 3-module home, which would be a small average home, there's 15 days and you've got it built ready to go.
But cost, regulation, financing and even public perception remain key barriers. This firm in Victoria supplies regional and rural worker accommodation.
In here we've got a laundry leading into the garage. The reason we've done a single garage is because you can't do a double garage in a modular build.
You can't do a double? Why's that?
Double garage has to be a minimum 5.5 metres wide, which once you add the the walls, it's too wide to be moved on the road. There is a perception around modular building that they are a lower cost, cheaper option. So people come looking at a modular thinking that price is going to be the selling factor, but we have to build to the same standard as any building, and therefore, there is no cost saving over traditional building.
Australia's Productivity Commission says the industry must grow if it's going to succeed.
We've faced some particular challenges in adoption in Australia. One is scale, and because it is essentially a manufacturing process, it works better when you have large levels of throughput.
The public need to come on board too.
I think people are not used to thinking about prefabrication. They might not think it's as good a quality.
Getting finance has also been an issue, but that's shifting, with Commonwealth Bank becoming the first of the Big Four to offer a standard contract for prefabricated homes, offering up to 80% of the total contract price before the home is on site.
Given the time frame is so much shorter, actually we believe that we can actually manage that risk because we are only holding that risk for a very short period of time.
All of these issues are not new. They were discussed in detail in a 150-page report for a federal government task force 51 years ago. One leading construction expert says it proves a decades-long lack of leadership.
The way the National Construction Code is actually played out, it's almost a different version in every state. Now, one of the downsides of getting this wrong is
without a national way forward, he says the industry will produce poor products.
The trouble is when one of these people fail, and there's been many of them, cleaning up is a huge challenge. It hurts the supply chain and it hurts the consumers, and it'll certainly hurt the brand of this type of construction, which has got lots of potential.
Potential that could provide a solution to Australia's housing crisis.
And that's all from Close of Business. For more on those stories, you can go to our website and catch The Business Monday to Thursday evenings at 8:45 Eastern Daylight Time on the ABC News Channel and after the late news on ABC TV. I'm Alicia Barry. Thanks for watching.